Hey there, I've got a great show for you this week. I'm talking to Philip Lane, the chief economist at the European Central Bank, who also happens to be my former economics professor from way back in the day, like way back, before the euro was even a thing, and we used to pay for stuff in punts over here in Dublin. We're talking all about the Eurozone and the state of the global economy. President Trump's economic policies are posing challenges and opportunities for both, and the European Central Bank is right in the middle of it all. The bank's boss, Christine Lagarde, says the ECB is in a good place. And that's partially true. Inflation is hovering around target, something other major central banks, including the Fed, have failed to achieve. But are things really as good as they look? Growth is stagnating in large parts of the bloc. Trade turmoil is still unfolding. And Trump's pressure on the Fed has implications for the global economy. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, the Eurozone's moment. So to get into all of this, I'm delighted today to be joined by Philip Lane. He's the chief economist for the European Central Bank and a member of its governing council, and my former professor. Welcome to Reuters Econ World, Philip.
Thank you so much. I look forward to the conversation.
Yeah, any mistakes I make, they're all your fault because maybe I didn't, maybe you didn't teach me. I'm joking. Philip, are we in a good place? I mean, I know we're in a good place. We're in Dublin, but are we in a good place economically speaking?
So I think if you look at the history of the euro area, one important defining feature throughout this whole time has been essentially high unemployment.
Right.
When I was growing up, or
when I was growing up, yeah.
You were growing up.
Yeah.
You would look around Europe and you'd see the definition of the European economy to be low unemployment.
Right.
Unemployment has never been lower. We are in the low sixes. And that really, I think, is a fundamental issue. The economy just works better when people are not scared about losing their job. The vibe, if you like, the feel-good factor is much better. So I would say, number one, having this very resilient labour market is very important.
Yeah.
Number two, look at the shocks we faced.
Right.
The pandemic, the Russian unjustified invasion of Ukraine, the really big associated increase in energy inflation and overall inflation. And as you said in your intro, this year now, we also have trade policy issues. And given all of that, the fact that the European economy is growing this year, growing more strongly than we expected a few months ago, I think it's quite important. There's no doubt that I would agree with people like Mario Draghi, who says, with a change in the policy setup, we could grow more quickly,
right,
and we should be more ambitious. But I think it's a reasonable assessment to say the European economy is growing, inflation's around target, unemployment is low, and therefore on any kind of misery index scoring, it's not too bad.
Talk to me about the trade turmoil, though. It is interesting, isn't it, the resilience that the Eurozone economy has shown in relation to the tariffs. Like, what's going on there? Is it just that the effect hasn't kicked in yet, or yeah? Well,
I think that's part of it. I mean, I don't think we should expect all of the tariff impact to be in year zero. As has been much discussed around the world, in year zero, people have accumulated inventories. There was front running before the tariffs came in. But maybe the most important element for us from a European perspective is trade with the US is important, but it's not the dominant factor.
Right.
For us, it's the local economy matters more. And then we also have to think about the fact that over time, from April onwards, where we are now in terms of tariffs is a lot less severe than the initial fears. And so it's a mix of tariffs being less than the maximum original risk factor.
Right.
The fact that the US is important, but it's not the predominant driver of the European economy.
But it's not nothing, right? I mean, I think the big question that everyone asks is, are global trade flows being rearranged, being reordered? Like, what's the data showing? What can you say?
So I think that's partly the answer. As you say, is tariffs have a big effect on the bilateral trade patterns. So, the most visible is the amount of trade of exporting from China direct to the US has gone down. So that is a very big reconfiguration for the world. China is now exporting more to Southeast Asia. Southeast Asia is exporting more to the US.
Right.
And China is also exporting more to Europe and to other parts of the world economy. So if I'm running an individual firm in an individual sector, depending on that sector, I could be much more obsessed by the tariff question. When you aggregate across the whole economy, it's contained.
But the IMF seems to be suggesting that it's US importers, it's US consumers that are really absorbing the pain from what's going on. But is that indeed the case? Is that...
By and large, I think that's right. There is, I think, an important unanswered question, which is we know a lot of firms involved in trade are global firms. They'll have a European affiliate, they'll have an American affiliate. So when it is stated that essentially American importers are taking a chunk of the burden,
right?
We don't really have the data to know what fraction of those American importers are parts of foreign multinational groups. So that remains who the ultimate absorber of the tariff hit, I think is unknown. But let me also say, remember, the American economy is doing well this year with the AI boom, with the fiscal situation. So under those circumstances, the ability of firms to pass through tariff hikes to the American importer and also the American consumer is reasonably robust. From my point of view, we're going to be looking at this very closely, but the answer, I think, will evolve over time.
So Christine Lagarde recently said in a speech that exports weren't necessarily a reliable source of growth anymore. Do you agree with that? I mean, it's always a good idea to agree with the boss, but do you agree with that sentiment, that argument?
So I think that the message is, I remember before the pandemic, there's a long period when essentially Europe was relying on exports. The domestic economy was recovering from the financial crisis. And for a long time, it really was a safety valve. China growing very quickly, China absorbing a lot of imports from us, and also, for that matter, for the US. So what is true is that kind of export dependence does mean your fate is out of your hands.
Right.
It depends on what the policy settings are in your major trading partners. So the overall message that essentially autonomy is a lot easier to deliver if domestic demand is strong enough, that's a pretty robust message. And we are seeing it now, for example, in fiscal policy. As you notice here, there's been a pivot in German fiscal policy.
Yeah.
And more generally, maybe what's interesting is, regardless of tariffs and so on, essentially the comparative advantage pattern in the world has turned. China is now very strong in lots of sectors. So regardless of the geopolitics, there's also a basic economic reality. The kind of relative attractiveness of exporting versus domestic sales has changed.
So you mean China's kind of gone from being a consumer to being a competitor, to being a rival?
Exactly.
Right.
So in that circumstance, again, I think it makes sense for Europe to think about, okay, how can we deliver a stronger rate of domestic demand? That's partly fiscal policy. It's partly reform, so that the incentives to invest in Europe go and to innovate in Europe go up. So I do think that phrase global imbalances, it's been around for a long time.
Yeah.
From our point of view, the message for Europe is indeed never to kind of avoid the opportunities of exporting, but in the context of having strong enough domestic demand that essentially the European economy can thrive no matter what the external environment.
It's really hard to be autonomous, though, isn't it? When you've got China there controlling some of the most important sort of variables that go into manufacturing. Like I'm thinking in particular about critical minerals, right? Like China is a big factor in this, isn't it? In the reordering of those trade flows and its role as a supplier. Yeah.
Well, I think, and again, this has been discussed for quite a few years now. I mean, I would share the overall view, which is we have to maintain as far as possible the multilateral trading regime. it remains the case. Trade is a positive sum in dynamic. It would be a real loss to the world. And some of our own work at the ECB would show if we really went to kind of extensive trade barriers, a lot of kind of breaking up of supply chains, that would be very damaging for everyone.
Okay, quiz time. The currency the ECB oversees is, of course, the euro. It started circulating in 2002. 20 countries now use the single currency, with its most recent adopter, Croatia, introducing it in 2023. But another EU member state is set to adopt the euro soon, at the stroke of midnight on New Year's Eve, in fact. So which country is it? Is it A, Latvia, B, Poland, or C, Bulgaria? We'll have the answer for you at the end of the show. Up next, a deeper look into the state of the Eurozone economy. Philip, it might be because I'm a child of the 80s and I remember like long unemployment lines and just, sort of a pretty dire economic situation, certainly here in Ireland. But is there a level of complacency around the Eurozone's economic performance, a bit how we're expected to do as a bloc? I mean, the most recent Reuters poll showed that economists expect, the economy to grow steady this year, to inflation to be at target, steady rates. Like, it just seems very nothing to see here at a time when there seems to be plenty to see here. No.
So I think this goes back to, where do you put the monetary policy headache in the context of the wider set of issues. So I'm pretty sure the people who are responding to your Reuters poll have the same horizon as monetary policymakers over the next year, over the next 2 years. And if behind all of that is essentially a European economy that is, again, with the exception of the balance between the external and domestic sector, more or less balanced in the sense of demand is not outstripping supply, nor is it falling short of supply. And for that reason, inflation's more or less around the target. But of course, if you had ambitious reforms, then if that expanded the supply capacity of the economy, it would also raise demand because there'd be new investment opportunities. There are many important challenges facing Europe, which would be a lot easier to handle if you grew more quickly.
Right.
But again, that's where you hand over from the kind of near-term drama which dominated the last few years with high inflation and so on, towards, I think the more fundamental issues about improving innovation, reforming the single market and so on. Those are not easy policy challenges to handle, but it remains the case that, if we want to expand the frontier of productivity, then, having all of the reforms which have been so much discussed to boost dynamism, boost productivity would be very welcome.
Yeah. If we want US style growth rates, we need to cut the red tape.
Well, red tape is part of it. That's true. But fundamentally, I think the top line answer is, and if we're taking the lesson from the US, is really having a genuine single market. We need the scale of pulling the European population into one market if we're going to really, have a return on the kind of investments that are kind of most germane in basically a digital economy. You need scale. And to get to scale, it's pretty difficult when you break up the European Union into 27 member countries.
Now, you mentioned there about economists looking at the aggregate, right? But drilling down below the aggregate kind of GDP growth rates, Germany is not doing well. Germany's stagnating, right? Are you worried about the disparity that you're seeing? You've got certain parts of the Eurozone where growth really, it's very weak. Italy, Germany, some of these big players.
So I think that is true. And of course, for us, think about the whole euro area, among the big countries, we do have to Spain, growing quite quickly.
Yep.
But behind all of that, essentially, it does come down to the size of the manufacturing sector, the level of energy costs, the demographic issue. So I think there's a good understanding of where these differences come from. So what I would say is I said to you, we want the European economy to grow more quickly. But But then you convert that into an implementation plan. The reality is a lot is country specific and a lot is very detailed, file by file, procedure by procedure. And so sometimes it's frustrating from the outside saying, what's going on. But the reality is this is just the dogged work of implementing reform.
Easier said than done, I think, is the bottom line, right?
Right, but it's still, I would say, it's doable.
Yeah.
And there are things happening. And again, maybe I'll go back to the fact that the periphery of Europe is growing roughly better.
Yeah.
And that's partly because a lot of these countries did go through reforms a number of years ago.
If money and finance is your thing, we've got you covered. Our brand new sister pod, Reuters Morning Bid, is your go-to market briefing 7 days a week. Here's a clip from a recent episode featuring the show's co-hosts, Mike Dolan and Anna Szymanski.
Up until essentially a few days ago, the consensus seemed to be away from the idea of further Fed easing. So why have we now shifted back?
There was a big swing on Friday, and make no mistake about that. John Williams, the New York Fed boss, was speaking in Chile, and he very pointedly said that there was room for another near term, which was the phrase he used, Fed rate cut, and that would be the third this year. And of course, that's been the debating point, whether there's one more left before year end.
To listen along, all you need to do is go to the Reuters app or your favourite podcast player. You can also ask for your smart speaker for Reuters Morning Bid to get that market edge straight from the experts in our newsroom. Or if you'd rather watch along, we've got a video version for you too. In the next part of the show, we take a look at what's going on in financial markets and what it might mean for the euro. Philip, how difficult does President Trump make your life as someone who's involved in monetary policy?
What we've seen from the US economy this year and in the context of the last several years, of course, the trade policy is an element of it. But we also should recognize that the other, if I want to kind of list out the main issues this year, the fact that they did pass the Fiscal Act this year means there's kind of a pretty significant, if you like, reinforcement of the fiscal path for the next several years, which by and large is kind of stimulative for the American economy. Mm-hmm. And in turn, by stimulating the American economy, that's important for the world economy and for us. And then the other element, which is, of course, has been building for years across different administrations, is essentially the AI activity.
Right.
It's all the talk of anyone who looks at the American economy, the American financial system. We've seen it in Europe as well. We see it in Asia. So that's a global technology innovation, which is now more and more visible in the European investment data. It's visible, of course, more visible in the American investment data and the American the earnings of the Magnificent Seven and so on.
The hyperscalers, yeah.
Right, exactly. So, and then I would say maybe the other very surprising element of this year was the dollar depreciation. So again, going back, I'm happy to talk about the US, but again, let me say all of that is important, but the euro area is a continental-sized economy. Most of the dynamics of the euro area economy are internal, and so I wouldn't want to overstate the importance of the US economy to Europe. The European economy will be driven by European decision-making. But since you asked the question, what I would say is tariffs clearly negative.
Yeah.
Dollar depreciation it works in different ways. Mm-hmm. AI clearly positive. Mm-hmm. And then the fiscal policy that will have a positive spillover in terms of keeping the level of demand in America reasonably robust. You
mentioned there also about the dollar, depreciating. I mean, earlier this year, with all the kind of the uncertainty that was caused by Trump's policies, Lagarde talked about, an opening for a global euro moment.
Yeah.
Has that moment passed in the sense that we have seen the dollar recover a little bit since the summer?
No, well, so I think it's a very interesting topic. And again, there was a dollar depreciation around the time of the April announcements.
Yes, with the tariffs, yeah.
Most of that has stuck. So that, the dollar has improved a little bit, but most of that, I would call it like a step change. It's not the biggest step change in the world, but it's a clear step change. What's important is it's broken the traditional correlation in the US that essentially the bond market, the stock market, and the dollar typically have a certain correlation pattern, which broke this year. So having a weak dollar this year is really a signal, I think, of more uncertainty about the US dollar-based system, more uncertainty about the dollar as a safe haven. And then when people think about both, European investors first and foremost, but also global investors, there has been a reassessment. And the way I would phrase it is, at the start of this year, there's a lot of US exceptionalism talk. That's been scaled down to some extent. So it's not the case people are saying, well, I need to go underneath some model-based view of the dollar weight in my portfolio. But I think they have concluded I was maybe maximally overweight at the start of this year. I need to downscale to some extent. But I do think maybe coming back is, and again, it connects to the reform agenda in Europe, a stronger euro would be a lot better for the European economy if we had a more dynamic capital market.
Right. If
we had a deeper bond market, deeper equity market. So when people say, well, maybe I'll increase my portfolio weight to the euro area, that essentially there's enough interesting assets for them to buy.
One thing that central banks kind of globally seem to be doing, though, is stocking up on gold. That does seem to be a trend among central banks, right? Is there, a gold bubble afoot among the central banking community?
Well, I'd kind of step away from that particular interpretation.
Okay.
What's clear as day, there's been a big run up in gold. And I think it's clear as day, again, that's partly this issue about people who move away from the dollar, some investors, maybe some central banks around the world are allocating more to gold. I think that's true. And that's been a really big run up. But what I would say is, when you think about it, I think the world would be better off if that investor appetite were funding productive investments in other economies. And as I said, I think the European economy would be better off if we had a more dynamic capital market. So when people say, I want to reallocate away from the dollar, they don't have to go to something unproductive like gold. They don't have to go to something unproductive like Bitcoin. And they can find financial assets that in turn will fuel the economic development elsewhere.
What about stable coins? I mean, we've seen in the US earlier this year, the legislation that was passed, these connected to the US dollar.
Right. I mean,
do you see that as something that's really offering support to the dollar's value?
So honestly, from a European point of view, this is not the first order issue. What I think is important is that with the wider discussions about the digitalization of the financial system, tokenized deposits and so on, is that Europe does adapt to a more digitized financial system, allowing room for euro-denominated stablecoins where they make sense. But of course, let me remind you, at the ECB, we do have well advanced our preparations for a retail digital euro. And at a wholesale level, we're also working to make sure that the role of central bank money in settlement in digital markets is well advanced. So I think the dollar stablecoin debate is interesting. I don't disagree that it's a new source of demand for US Treasuries. To the extent US Treasuries will be an important backing for stablecoins. But what I would say is, from our point of view, I'm not expecting a big shift in the behavior of European institutions or households because, in a euro-denominated European economy, there's an obvious currency risk. if you decide you're going to do transactions in dollar stable coins.
I've got some big news to share, especially for our American listeners. On December 3rd and 4th, I'll be in New York City for Reuters Next, our flagship live journalism event. I'll be hosting a panel all about Trump's economy. You can sign up to watch the live stream or join me in person by clicking the link in the show notes. You won't want to miss it. In the final part of this show, Philip and I talk about challenges to central bank independence. Philip, how worried are you about Fed independence? Trump is putting a lot of pressure on the board to cut rates right now.
The Fed board, the FOMC, these are very professional people. And I would expect the decision maker to focus on their mandate. And you've not seen, I think, in terms of decision making, any move away from that very professional, very data-driven approach. So long as the Fed continues to make decisions on a professional basis, then extracting any kind of directional signal from all the noise remains uncertain.
We are seeing a lot more divisions, though, aren't we? Like coming out in terms of, hawks versus doves, particularly, I suppose, as we come up to the December meeting, which way it should go. And when I look at other central banks, the market very much seems to be able to handle that in other central banks. So like for the Bank of England, you'll often see kind of quite tight decisions. Is the market kind of prepared, able for a Fed that's split on?
Well, again, I don't really want to say too much about how the market is kind of tracking the Fed, because
it is an interesting development, though, isn't it? Like in terms of the evolution, because we're used to seeing, I suppose, consensus.
Well, again, and we're a very consensus-based approach at the ECB. So again, and every central bank has its own tradition. As you say, the Bank of England is known for close votes sometimes.
Yeah.
But maybe a bit like us, given the mix at the Fed between the Board of Governors in DC and the regional Fed presidents, whether in a given year they're voting or non-voting. Let's see how that develops.
How do you at the ECB, how do you get consensus? Because you've got 26 members. It's quite something. Like, how do you establish that in the run up to those rate meetings?
Part of it is process.
Right.
The Governing Council meets, as you say, all the members. But in the run up to that meeting, there's a lot of committee work.
Right.
So the committee work involves all of the national central banks. So the ECB has an important role, of course, the Frankfurt-based staff. But the analysis, the forecast is built on a lot of shared information. I very much rely on the individual central banks to inform the wider discussion about developments in individual countries. So I would say the most important element is essentially if you have a shared analysis, a shared diagnosis, given the nature of monetary policy, this, of course, can still remain different risk assessments, differences across individuals. So that's one. It is the whole bureaucracy is set up to generate a shared analysis. And maybe number two is the value. Mm-hmm. People understand as a pan-European institution, it's extremely valuable to have a consensus-based approach.
Right. Markets like it.
Well, regardless of the market, I'm sure the markets like it, but I think it really helps the communication of monetary policy if essentially it's understood that this may not be any individual. I mean, I say one version of consensus is everyone is equally unhappy. That I think is important.
You have managed. I mean, inflation is more or less at target. Is there a feeling of smugness around the table? How is ECB's managed? Is it a microphone drop, walk away, job done? What's the...
So maybe, again, what's important, and the reason why, is what we have now is this year, inflation is around the target for sure. But what we have is a split. Non-energy inflation this year is still around 2.5%.
Okay.
Whereas energy prices have been falling. Mm-hmm. That's not a sustainable pattern. We're not going to have energy prices falling every year. So we do think there's more work to be done next year in terms of delivering non-energy inflation, getting down to target. We think it's going to happen. But until that happens, there still remains, I think, reasonable questions about the sustainability of being at target. And that's important from a medium-term perspective. We think it's going to happen because there's still this year has been a lot of aftershocks from the high inflation period. In particular, it's still the case now, wage inflation is high compared to, if you like, the historical norm. And that is because there's still catch up in some parts of the European labour market from the high inflation episode. But we think from next year onwards, that wage dynamic should be more forward-looking rather than catching up with the high inflation episode. So I would say, if I was going to drop a mic, it's not now.
Okay.
But if we have non-energy inflation sustainably around the target, energy inflation is always going to be potentially volatile, given the volatility of global oil markets, and we've learned the volatility of the gas market as well.
Yes, and the way the European energy market is set up anyway, right? We rely on, the US, we rely on different suppliers.
Right. So I think that for me is important. And also for me, it is important, going back to where we started maybe, that we do have low unemployment. We do have a steady growth rate in the economy.
Maybe I'll ask you your microphone drop question, the last one. What keeps you? What are the things that worry you then as a central bank governor? What keeps you awake at night?
To be honest, I mean, I think for central banks these days, they're the same concerns as I think everyone has. It's really security, the geopolitical situation. Of course, most immediately, and for us, our immediate neighbours with Russia, Ukraine. But of course, around the world, there is a shift in the kind of geopolitical world order, if you like, and that creates many risks in terms of geopolitics, economic security, political configurations, and we would have to deal with the fallout for the economy and for inflation. But those are risk factors which, of course, really dominate the whole social political discussion.
And outside monetary policy, as an Irish person, I presume one of the big concerns is whether or not we're going to qualify for the World Cup in 2026.
No, absolutely. And of course...
What's your take? Are we going to do it?
I will be hopeful. I would note the two countries we play, if we beat Czechia, then... maybe Denmark. For the euro area, it's important that Ireland wins.
Philip Lane, thank you very much.
Very good. Thank you.
A big thank you to Philip for his time and insights. You can get all our great economic coverage on Reuters.com and the Reuters app. Now for that quiz. I asked you to tell me which EU member state is set to adopt the euro on the 1st of January 2026. Is it A, Latvia, B, Poland, or C, Bulgaria? And the answer is C, Bulgaria. The Bulgarian lev or lion has been in circulation since 1881, but it'll be replaced by the euro at the start of next year. That'll leave just 6 EU member states outside the eurozone: Sweden, Romania, Poland, Hungary, Denmark, and the Czech Republic. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comment section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Sebastian Sommer. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.